Okay, yeah, thanks a lot for, first of all, to the organizers for having us in the program. It's a great presentations, great discussions. So it's really good to be back in a room with real people. And this is a joint work with Matthias Meyer from Mannheim, Imo Short in Montreal, and Timo Reinert, who is a PhD student who will be on the market in the fall. And the motivation is partly given by Shebnem. So firm debt is important. Another reason to care about firm debt is here. It's as a relative to GDP, firm debt is increasing over time. And most importantly, what we care about is not only debt, but the maturity of debt. Here we look at a variable called the maturing debt share. So at the firm level, we look at a given point in time, all debt of that firm. And here we look at how much of that firm will mature within the next 12 months. That's the maturing debt share. And this is from Compustat data in the US. And we look at the distribution of maturing debt share across firms at one point in time. So here we have 2019. And we see at that point in time, almost half of these Compustat firms, for them less than 10% of their total stock of debt would mature before beginning of 2020. But there were about 10% of firms, for them more than 90% of their debt would be due within the next 12 months. So these firms, of course, have very different maturity structures, and we ask, how does this matter for monetary policy? That's our...
Those numbers are much lower in Europe, right?
So in Europe, one big difference is there's more bank financing, and bank financing typically is shorter maturity. Then again, it's a bit more, there's lots of renegotiation, which makes the effective maturity even shorter. So that would be my hunch. But here I will only use US data. So theory, please, Basil.
So the same picture, but like taking into account the firm size, would that look the same? Or are the firms that have a small maturity only small firm or only large firm?
Yes, there's a correlation between, even in Compustat, between being large and having long maturities. Okay? And later we will talk about more that in the data and in the model. But
If you were in share of revenue, then distribution will look way flatter.
Yeah, this is a good question. So we didn't look at this at all. But this is just to motivate, and then we get details later. But yeah.
What kind of debt is this?
So this is all debt. So bonds and bank loans.
And is it both fixed rate and
Yes.
variable rates?
Yeah. So for bonds, fixed rate and variable coupon. Yeah.
Variable rates, yes, because firms are often have flexible rates.
Yes. So for bonds, it's a very tiny amount share, which is variable rate. But for banks, it's a big amount. So yeah, this is everything together here. Yeah. At this point, later we will zoom in and only non-variable coupon bonds. But that's for the future, close future. So here, when we ask this question, how could monetary policy, how could debt maturity affect monetary policy? Theory tells us different things. So theory, on the one hand, tells us a firm with lots of short-term debt, with lots of rollover needs. So the path-through of interest rate changes to interest cost of the firm and the cash flow of the firm is higher. So this could mean that short-term debt should increase a firm's investment response to monetary policy. This channel we'll call rollover risk later in the theoretical part. On the other hand, there's also a mechanism whenever monetary policy changes inflation. So for instance, contractionary monetary policy lowers inflation. This has effect on the real value of nominal outstanding debt of firms, and this effect is stronger if this debt has longer remaining maturity. This now would mean to a debt overhang channel that long-term debt means a firm has a big investment response to monetary policy. So both of these mechanisms could be there, or maybe more. But since theory does not give us all the answers, so first of all we look at empirical evidence. And what we do is we look at more detailed maturity data than I showed you before. We look at bond level information. And this will be important to get our results. And we merge that with firm balance sheet data from Compustat. And we use monetary policy shocks together to analyze how in the data the maturing bond share will matter for investment response to monetary policy. And we find, first of all, the preview, firm investment of firms responds more strongly to monetary policy shocks if a firm has a large share of maturing bonds at the time of the shock. This is what empirics tell us. Now, to understand how does this empirical result matter for monetary policy, should this matter for the design of monetary policy or the effectiveness, we have to turn to a GE model. And so we write down the New Keynesian heterogeneous firm model. The important new part is that we have endogenous and heterogeneous debt maturity across firms. And in this model, it can, first of all, replicate lots of cross-sectional facts about debt maturity and things like firm size, age, leverage, credit spreads. So this model, so correlations, what you were asking about, they are in the data, and also the model does a good job in matching them. That's nice. So it's a useful laboratory to think about policy in this model. And once we do that, we find that indeed, what we did in the empirical part, also in the model, we run the same regressions on simulated model data, and we can replicate the finding that it's a large maturing debt share, which makes firms more responsive. Turns out the rollover risk channel will be small, and debt overhang is important, perhaps surprisingly, but this will be explained later. It's a cliffhanger here. Right, so if you know more questions, I will try to dive in directly to empirical evidence. So what we do here is we, as I said, one important part of the analysis is we have detailed bond level information from FISD. So we know exactly when a given bond of a firm is still outstanding, when it is maturing. And so we can merge that with quarterly Compustat balance sheet data. And one thing is then we focus on a special sample of firms. So it's not only, we all know that Compustat, you know, this the US listed firms, that's a subsample of firms in the US. Now we look at a subsample even within this subsample. So we look at the Compustat firms with outstanding bonds. And these are typically, even within Compustat, the bigger firms. So we have a small number of firms than in Compustat. Furthermore, we only consider fixed coupon bonds instead of variable coupon bonds, and also non-callable bonds to make all these bonds very comparable. And after doing all these restrictions, applying them to our sample, we are left with 30,000 firm quarters. We start in 1995 because that's when our bond level data is available, and we end before the COVID crisis because that's when our data ended at the point. And it's a subsample of firms, but they are so big that still our subsample of firms still accounts for about 50% of total firm debt in the US at even given point in time. So we still cover a lot of the aggregate economy in terms of debt. And for these firms in our sample, they are bond issuing. For them, bonds is the primary source of outside financing. So more than 50% of the total stock of debt are bonds, the rest being, for instance, bank loans. And these bonds at issuance typically have a long maturity, about 8 years. And whenever these bonds mature, about 50% of this debt is rolled over within the same quarter. So that's very common in this sample here. Okay, and the key variable is now, it's almost the same as, yeah, please?
So how much of the whole economy does your sample represent? I mean,
Yeah,
share of GDP or share of employment? Or
I think, I don't know the exact number. I think in terms of sales, for instance, it's about 30% roughly. So it's a bit less than debt, but yeah. Okay.
It's around 50% of value added. Corporate sector, publicly traded corporate sector. Compustat is 50%.
Yeah, and then we have a subsample of Compustat, but the larger ones in Compustat. Yeah. Okay, so the maturing bond share, this is almost the same as before. So now we look at a given point in time. Please.
You know, did you check whether the bonds are if there's any interest rate hedge? So
we don't have data at the firm level if they're insured against.
FISD does not include derivatives.
So at least not that.
Company like big companies like Apple will have pretty sophisticated treasuries, and they may hedge the interest rate risk of the rollover. Yeah.
So that's a good question. We didn't look at this. This would against us finding any results. So that would be downward, could be downward bias, I guess, in our results later. But we didn't look at this. That's a good question, yeah. Okay, so this is maturing bond share. What's that? So at a given point in time now, given that we have the bond level data, we can be even more precise than with Compustat data. So we know here now for 1 quarter we calculate how much of bonds are maturing in a given quarter and relate this to the total stock of debt. We could have other things in the denominator here, assets, fixed assets, sales, and the results do not matter much on what we put in the denominator here. And this is our key variable, which tells us which firms have lots of refinancing needs in a given quarter, and see how this related to monetary policy shock. So since this variable is very precise, it's for a given quarter, and these bonds have long maturities, we have many observations in the sample with 0 maturing bonds in a quarter. But when firms have positive maturing bond share, it looks like this here. So conditional on a positive maturing bond share. Most firms apparently are careful not to have too many rollover needs in a given quarter, but some of them have significant exposure to rollover. Have high maturing rollover needs in a given quarter. Okay, and lastly, monetary policy shocks. Here we try to do what state-of-the-art monetary policy analysis does a lot these days. So we have a high frequency identified monetary policy shocks, price changes of federal funds futures within a 30-minute window around FOMC announcements. We aggregate them to quarterly frequency to make them compare with the rest of our data. And in order to account for potential information transmission effects of these meetings and announcements, we apply sign restrictions and exclude unscheduled FOMC meetings, which itself might be a surprise information event for the market. But nothing here, we try to do exactly what people these days are doing when they do monetary policy analysis of this sort. Okay, and so our baseline result in the empirical analysis, the main result is here. We estimate a local projection at the firm level or in the panel of firms where we relate firm level capital, how this changes over time between the period before monetary policy shock at a horizon of up to 16 quarters ahead. And we rest that on firm fixed effect, sector quarter fixed effect, on the maturing bond share, and the key interesting thing is the interaction here between monetary policy shock and the maturing bond share. So in the baseline, nothing else is added in the regression. Later we add more things. But first of all, we're interested in this interaction coefficient. So if it's a positive estimate, it would mean after a contraction monetary policy shock, having a high maturing bond share reduces the negative response of investment, or a negative estimate would mean after contractionary monetary policy shock, a higher maturing bond share would mean a more contractionary response, an amplified response. And when we look at the result, we find that indeed a high maturing bond share amplifies the negative response to a contractionary monetary policy shock. In particular, if this is here scaled to compare two firms, with a 10 percentage point difference maturing bond share. And if we compare the two, then 8 quarters after the shock, we find that the firm with the high maturing bond share, its capital stock was more than 1% lower than the one of the other firm. 95% confidence intervals, and this is the first baseline result. And there are many questions. Maybe first, Carolina.
Something really quick. So why capital stock and not capital investment? So what's in that capital stock?
So investment is a bit more noisy. So here we try to look at the persistent effect. So this is kind of the accumulated investment effect. But maybe this investment check, investment.
But that capital stock is tangible, so this is.
It's fixed capital. It's exactly. It's plants, property, equipment.
Thank you.
Any evidence that these firms, are in any way different between? The debt maturity is somehow.
Exactly. We want to control for many things. That's.
Firm fixed effects and.
So I hope to address this in the next slide.
But talking about the control, so you put the debt to assets ratio, right? The debt to net worth ratio, in the end, is in the controls. I wonder if the maturity is correlated with the amount of debt that you have? and also you do the interaction between the debt over the asset.
Exactly. So I think I think many questions might be answered on the next slides, hopefully.
Do you have the coefficient without interact with the monetary policy shock? I just want to know what the effect of M is on investment.
So it's here. I don't have it here. I cannot tell you, but this would be like the average effect of having high M on average investment.
Is it positive, negative? I'm sure when the next picture, is it amplifying? Is it going the opposite direction? Do you know what the sign of gamma is? In your estimates?
So yeah, I'm sorry. I guess it's so. I think on average, what I can tell you. So, but here I'm guessing. So high M on typically this will be firms have more often high M when they have short maturity borrowing. So smaller firms. So I would guess they have a higher investment on average. But yeah, here we really focus on what happens after monetary policy shocks. That's the event.
A lot of it, then I'm going to invest a lot. You're saying that, and then if on top of it there's a positive monetary policy shock, I invest less than I would have if there wasn't. So I mean, just so that I can even interpret BH, because BH is always relative to gamma H. Is it an attenuation or is it a going in the direction?
Yeah, exactly. BH is relative to exactly the average effect, exactly gamma H, which I cannot tell you right now, and then comparing.
No.
Yeah.
Pretty important actually.
Okay.
Going to is relative to gamma.
Okay, maybe, so...
Just to understand the way you want to... So what is this telling us? It's telling us that firms that have a lot of debt they do now, they have a bigger contractionary effect when interest rates rise.
An investment.
Exactly. When they have, exactly.
Okay. So this is contrary to the rollover hypothesis, more or less?
No, sorry, this would be in line with the rollover risk channel, exactly.
Other measures on the left-hand side instead of capital, so something else?
Yeah, so we tried different measures. So sales goes in a similar direction. So far we didn't, so we look more into this. For instance, for debt and leverage, we didn't find significant clear results as an outcome variable. So that's a bit what we keep on looking at and try also to use our model to help us understand that. So that's a bit an open part, yes. So today I will only focus on investment or capital stock.
And so this is a particular type of capital, so physical capital.
Yes, exactly. Okay, so I think some questions were already about robustness of this result. For instance, there's lots of cross-sectional heterogeneity across firms, which correlates with their maturity choices and maturing debt bond shares. So the blue line here, we only look at within firm variation. So we only look at how the maturing bond share differs from the average maturing bond share of the firm. So within firm variation, we get a slightly dampened estimate. And once in addition, we also include lots of firm level controls, which in principle might be correlated with M. So things like leverage, assets, liquidity, sales growth, etc. Then the estimate again even becomes a bit bigger. Okay, so this result is pretty robust no matter what we throw at this regression. So these are all interactive with monetary policy shocks as well, not just the maturing bond share. And no matter what we throw there, this estimate is pretty robust. So that's a finding which we repeatedly find in the data.
And the reason why I'm asking is that there is this paper by Cloyne et al. That says that whatever O'Donnell and Wimberry say that drives its sensitivity of investment to, you know, financial frictions, etc. If you put age in, the kind of age explains everything. So I'm just wondering if because I guess it's kind of correlated to the maturity structure of the firms.
Exactly. So something we didn't.
First, so they should all be.
But still, yeah, it's on our list. So we didn't do it yet, but it's on our list. Yeah. And so we also do a placebo exercise. So we look at not maturing bond share today, but the one in the quarter before the monetary policy shock. And if we do that and we compare two firms which had loss of maturity, bonds maturing before the shock, if you had that or not, this doesn't give you any significant difference in the response to the monetary policy shock in the next period. Presumably after firms have rolled over their debt. That's a placebo exercise if you want. And lastly, because you mentioned other research which looks at heterogeneity of firms related to leverage. So one thing is, of course, does debt level, debt maturity matter more? And so here to do this, we kind of, if you want, do a small horse race. So first of all, we take out again our bond information variables, just look at leverage. Of course, in this special sample of large corporate debt firms which are issuing bonds. And there you find, first of all, yes, some result which is a bit in line with, for instance, O'Donnell Winberry, that having higher leverage at the time of monetary policy shock means the contractionary response is dampened. So it's not, it's at some point significant, not super strong. Once we add our bond variable, we get still, our effect is still there, and leverage is even a bit driven out. So this, at least this analysis in our sample tells us it's not just the level of debt which you should care about, but the maturing date. That's something which we probably, so far did not have much in our models, or to some extent analysis empirically, but so that's something to, suggesting that debt maturity might be something to look at in the future. Okay, any more questions about empirical part?
Yeah, so do you have anything that that directly speaks to the channel of
rollover?
Yeah. So is there any indication that this activates a financial friction?
So something, if we would have credit spread data on secondary markets, this would be something great to inform us, but we don't have it in a sample.
Because one concern would be, I mean, not that I believe in this model, but if you go like, Modigliani, Miller in a frictionless environment, somebody could argue, well, maybe what's going on is that this is the risk-sharing arrangement that the economy needs. So basically, firms that are taking more long-term debt are essentially, or that are short-term with short-term debt, are essentially exposed to interest rate risk. But that's something that the economy needs, because they're also correlated with sectors that have to shrink in certain periods.
Although in this economy, probably you wouldn't want these firms to adjust the investment to that necessarily. I mean, the cash flows maybe.
I'm just thinking that there could be an aggregate shock that correlates the investment in that sector with the monetary policy, and then that sector has to pay off to the rest of the economy, and that's just an arrangement. Maturity is just an arrangement to get resources out of that sector. It's not that I believe in that model, but I think there's a Modigliani Miller representation of sector shrinking and more exposed to interest rate risk.
Okay. Yeah.
So something directly speaking to financial frictions would be great.
So what you picking on Saki? And I think I don't know, I don't remember. So you have only bonds, you don't have banks debt. So you have only bonds, commercial debt. So you have debt by banks when the firm is borrowing from banks, when it's buying when it's borrowing in the market. It's all in there, it's only one kind of debt.
So denominator is everything. So this M variable denominator has all debt of these firms.
Bonds.
Yes, exactly. Yeah.
So I don't know how much is the debt with banks in there. Can you do a similar regression using the banks? The firms that are borrowing directly from the banks rather than issuing bonds? You didn't try that?
So one thing which about banks is, so first of all, we don't have that good data about when bank loans are maturing. And second, even if we had that, I would not be sure how to interpret that, because these bank loans are renegotiated on a continuous basis. So once per year, at least something changes in these bank loan contracts, including the maturity, but also the face value, etc., interest rates. So that's something, I don't know if it fits very well, this exercise. So I think this is very clean here with this fixed coupon, non-callable bonds issued many years ago. If they mature at the time of a shock or 1 quarter before, this is the effect which we have here.
But you could put the floating rate debt in the numerator.
There's very few bonds with floating rates. But
it's not whether the bank debt, which is more likely to be floating rate, is it not?
You're saying, we could interpret it as an instant limit. Exactly, we could do that if you would have the data by firm level, which we don't have. But this would be a good way. Yeah, exactly, it's true. Okay, so partly to answer this question, which kind of model can rationalize this, and how does it matter for policy? We do exactly that. We write down a New Keynesian model where monetary policy has an impact, so we need sticky prices. We have a Taylor rule. Then to discipline this model with the evidence, we try to have the same aspects in the model as in the data. So there's firm heterogeneity, firms receive idiosyncratic productivity and capital quality shocks. There are financial frictions, otherwise debt maturity would not matter at all. So first of all, there's a trade-off between equity and debt. There, nothing super innovative is happening. So firms like debt because there's a tax advantage of debt. Interest rates are tax deductible. This pushes towards debt. There's also an equity issuance cost. This also makes debt attractive. So what makes the leverage choice, the capital structure choice interior is that there are default costs. So whenever a firm has a bad idiosyncratic shock and a high stock of debt, then ex post for shareholders it makes sense to default. And default is inefficient. There's a dead weight loss in the economy. And this is priced in when firms issue debt. So if a firm with high leverage issuing debt has a high likelihood of default, so people price in high expected default costs, and this makes it expensive for the firm to borrow. And that's why we have an interior capital structure choice. What is new in this model is that we also have an endogenous debt maturity choice. And this is key to speak to our data. So maturity choice, on the one hand, firms like long-term debt because it's a debt issuance cost. Whenever you sell a bond, you pay a small fee to the investment bank to float these bonds for you, like in reality. This is costly. So long-term debt, this is an advantage of long-term debt because a firm can maintain the same level of debt because debt is maturing at a slower rate, you have less issuance per period to maintain the same level of debt. So that issuance costs push towards long-term debt, going at long maturities. So what is bad about long-term debt? This is, in this model, the less trivial question. Debt creates debt overhang in the future. Long-term debt creates debt overhang in the future. And how does this happen? So as I told you, the price of a bond sold by a firm in a model with default depends on future default risk. The firm here can control default risk to some extent because it can control leverage. And having a high amount of debt relative to assets implies that it's more likely in the future to get shocks which trigger default ex post. So high leverage makes default more likely. So when a firm sells long-term bonds to the market, it would like to promise to maintain low leverage in the future because then you get a high bond price from investors. This would be great. The promise is, the problem is that once the firm has sold the long-term bonds to the investors, in the future, the firm will again decide about leverage and will still internalize all the benefits of higher leverage, the tax benefits here, for instance, but it will not internalize anymore that it lowers the expected payoff of existing bondholders. Because once it has sold these bonds to these people, the firm does not care anymore about the externality which it exerts on them through its own leverage choice. And so ex post, leverage will be higher ex post than optimal ex ante. And that's a problem, a commitment problem, and also for the firm. Because in the end, when a firm sells long-term debt, investors anticipate that they get screwed in the future, and so they demand a high interest rate. So they pay a low bond price for the long-term bond. So in the end, the cost of this commitment problem are borne by the firm shareholders. So that's the downside of issuing long-term debt. It comes with this commitment problem in the future, and you can avoid this by issuing only short-term debt. Because with short-term debt, you roll over all your debt every period, and so everything you do with leverage is reflected in the bond market revenue which you get for your debt, and so you internalize all costs which you impose on creditors. So that's the downside of long-term debt. So in this model, issuing long-term debt distorts future leverage, reduces bond prices, and because investors are forward-looking, reduces them already today. So this effect is stronger, as we know from literature, if long-term debt has longer remaining maturity. But here it will be important, it's also stronger if a firm ex ante has already higher default risk. So if you have two firms, and for a given stock of debt, one is more risky because there's a more volatile business model, for instance, or is more volatile profits, then default risk per se is higher and also more elastic with respect to firm behavior. And so for this firm with higher exit default risk, debt overhang is a bigger issue. And so this firm has a bigger cost of going long term and will be pushed towards borrowing short term. And this is key for our model to replicate certain cross-sectional effects in the data. So,
sorry, just one. So you're very far away.
In default, this dilution problem doesn't arise, basically.
Exactly. Exactly. Because externality on existing creditors only works through a change in default risk. Yeah. So it must be positive, and the higher it is, the more elastic it becomes. Okay, and in the model, what happens? So we have small and large firms, and we have a fixed cost of operation. So small firms are less profitable. What does it give us? It gives us that these small firms have, for a given amount of debt, higher default risk. So they pay higher credit spreads. And they react to that by choosing lower leverage. And within the debt which they issue, they are pushed more towards short maturities. So they choose a lower share of long-term debt. And so per period, they have a higher maturing bond share. And this is nice because this helps us to replicate cross-sectional effects in the data. So here, for instance, the red line is the model. And here we have firm groups ordered by size in the model. And we have that smaller firms pay higher credit spreads than larger firms, because smaller firms have high default risk. And this is in line with Compustat data. The blue lines is Compustat. They are confidence intervals. Here they're very large, because in Compustat, as we said, we have very few small Compustat firms which are bond issuing. And for this graph, we need bond rating data to construct that. So that's why this bar is very imprecisely estimated, if you want. But you see this downward pattern also in the data. Leverage, the opposite pattern. In the model, small firms, because they have, for given stock of debt, a higher default risk, higher borrowing costs, they lower leverage and increase it when they're large. You have the same pattern in the data, leverage increasing in firm size. And importantly for us, one key variable is the share of maturing debt. And as we said, having lots of long-term debt means low maturing bonds per period. And so firms which are small and face high default risk have high cost of debt overhang, so they issue mostly short-term bonds and therefore have high maturing debt shares per period. And this number is falling in size. Yeah? In the data, more steeply than in the model, but the tendency is both there. This is not targeted, so we're happy with that.
Untargeted.
Exactly. Everything. We have nothing, no parameter. We don't even know how to target that, so it's not targeted. Yeah, and by age are similar patterns. So here we have the size variable here, but not yet in empirical analysis before. And okay. And now the question is, what happens after monetary policy shocks? This is what we're interested in this paper. And so first of all, in the model, it happens what you expect to happen. So it is a price increase in nominal interest rate. Prices are sticky, so the real interest rate also increases. And first of all firms now want to invest less. That's clear. So aggregate impossible bond funds look, like you would expect them, like they should look, more or less. So what we're interested in now is what happens across firms. And so in this model, we have these two channels which could matter in this model, rollover risk and debt overhang. So let's look at the two. Rollover risk, how does it matter in the model? So this is how firms finance capital. There's some existing stock of debt Q. They can do equity issuance E, which is costly, so firms don't like it per se. And they can sell short-term bonds on the bond market, generating at the price P, S, per bond. And they can sell long-term bonds on the market at the price PL. And the stock of long-term debt is B tilde L. This is the existing stock of debt when they come into the period. This is in real terms, so divided by inflation. And so if you have, imagine all debt here is short-term debt, so you have only B tilde S standing here, then everything which moves around the bond price has a large effect on cash flow per period, because the entire stock of debt is rolled over per period, a high pass-through of interest rate changes. If you have the same amount of long-term debt, issuance per period will be smaller because to maintain the same amount of long-term debt, you always enter the period already with some amount of existing debt. So issuance is smaller. And so if this thing is smaller, and this price here moves downwards, this affects the cash flow much less because you only roll over a small amount of your current stock of debt. And this is how short-term debt in the model exposes firms more to interest rate changes. And long-term debt matures more slowly and therefore less rollover per period, and therefore long-term debt insures firms against cash flow risk and against rollover risk and the pass-through of interest rate changes to their cash flow. So this goes exactly in the right direction what the data tells us, the empirical analysis before. However, it turns out this effect is small. So given interest rate changes and given the amount of debt which firms have, the cash flow effects are small for firms, and you need huge cash flow sensitivity of investment to rationalize the empirical estimates. So we can already, even a back-of-the-envelope calculation would tell us that cash flow risk, or this rollover risk alone, is not sufficient to explain our empirical estimate. So what will happen, what will help us here is debt overhang. And that's a bit surprising.
Can you explain to me why there's rollover risk also on the long term? The last term. Can you explain where it's coming from?
Okay, so even if you only use long-term debt, still you issue some debt per period. So this is positive. On average, maybe if you even if all your debt is has a maturity of 4 quarters, still every period we assume. So it will be in this model. It's still true that every period you issue some debt. You just issue less debt per period.
I guess I'm thrown off by the fact that you said that you had this lumpy. I understood that it was lumpy, the long-term
exactly,
because you have a fixed cost.
Exactly.
But if you're rolling over every period, I'm confused. You're not paying that fixed
cost?
No,
sorry. So the cost which you pay for debt issuance, there's not a fixed cost. That's can be linear cost, and here we use a convexly increase, but it's a variable cost, not a fixed cost.
Okay.
So actually, it would be nice to have a more lumpy issuance of long-term debt because it will be more in line with the data.
You mentioned frequency, and it has nothing to do with the frequency. It has to do with the shape.
It's more
frequency has to do with how lumpy it is.
Okay, that's a good point. Yeah. Okay. No, but exactly. So in the model, there's no lumpiness in debt issuance. So it's more the amount of debt per period, and if you have less issuance per period, okay. Okay. Important here will be debt overhang. To help the model rationalize what you have in the data, debt overhang is key. And so what happens if contractionary monetary policy shock reduces the market value of capital of the firm, QK, and inflation pi? Both these effects increase the real burden of existing nominal long-term debt relative to what the firm would like to have as assets in the firm. So the easiest thing way to think about this is the debt deflation idea of Fisher. No? So you have nominal debt outstanding, B. Inflation is lower than expected. This increases the real burden of outstanding debt. And now debt overhang is a bigger issue because effectively you have more debt now relative to what you expected to have. This means default risk is for all firms. Debt overhang is a bigger issue for all firms. But because these firms with high default risk are more exposed to that because their default rate responds by more and their investment is more responsive to default risk. It is the firms with high default risk which react more to this increase in debt overhang and which for them also then their default risk increases by more after the shock. And so in the cross-section of firms, these are the firms with high maturing bond shares, or in their life cycle, these are firms, they choose high maturing bond shares per period at times when they're risky and have high default risk. And so this gives us, in the model, will give us the correlation which we have also in the data. This pushes in the same direction. So not only rollover risk pushes towards high maturing bond shares having high responses, also that overhang pushed in the same direction because of the high increase in default risk of firms with high rollover needs. And just to illustrate this, here we have 2 firm groups in the model, and the blue graph are firms with low maturing bond shares. On average, they have a low default risk before the shock happens even. The red line here is the averages of a firm with high maturing bond shares. On average, they have a high default risk. And when the shock happens in period 2, default risk increases by more for the red firms with a high maturing bond share. And this contributes to their investment going down by more after this thing. So the default risk here is important for the model to rationalize the empirical estimates. And yeah, the final result is we run the same regression in the simulated model data as in the as in the empirical part, and we find the same coefficient here to be again negative. And yeah, it's in the ballpark of the magnitude which we had in the data. But the only way to get really in this ballpark is to combine both rollover risk and debt overhang. That's how the model can rationalize what we had in the data. Okay, and so then we conclude. So how does debt maturity matter for the effectiveness of monetary policy? This was our question. First of all, empirically we find that firms react more strongly if maturing bond share is larger. That's a robust finding which we had in the data. And in the model, the only way what we found to rationalize that is that both rollover risk and net overhang contribute to that. That's our rationalization of this result. And now we're in the ballpark of the empirical estimate. And so now what is a bit missing, I was alluding to that, but we still have to finish really to cleanly decompose the importance of these two channels which I play in the model, rollover risk, net overhang. And once we have done that, one thing, of course, one can ask is then how does now an economy where firms have different debt maturities, we know that it matters for monetary policy, so now maybe a policymaker can ask how should I take this into account? So how should maybe the Taylor rule react to that in response to different shocks? And also now maybe in the future we will see interest rates hikes again. And a given interest rate change has a different impact in the model depending on maturity structure of firms in the economy. And this thing moves over time. So just to give you a last graph here, over time, this is for instance, the green line. In Compustat, the average maturing debt share across firms, and this has a secular trend. So it's going down, so firms move towards more long-term debt, perhaps because the term structure is a bit compressed. And so having the same interest rate change here or there has a different effect in the economy. That's what empirical data tells us and what a model tells us. So this is something to think about more, maybe within this project, hopefully.
Thank you, Joachim, for your various presentation. Thank you for inviting me to discuss this paper. I learned a lot reading this paper, and I also had a lot of questions, just as the audience, so it was really stimulating. Okay, so let me just, in one slide, just summarize what I think are the contributions of this paper. There's, in my opinion, one empirical contribution, which is to show the conditional larger response to interest rate hikes of firms with a larger share of maturing corporate debt after such shocks over this sample. There is also, in my opinion, a theoretical contribution because the model that is built is a complex model of heterogeneous firms with many financial decisions. The structure of financing is endogenous between equity, short-term debt, and long-term debt. The allocation choices are endogenous, time varying between these financing options, and further there is endogenously costly default risk and exit risk as well, and exogenous entry. So I think all these ingredients together are very interesting, and I really praise Joachim and his co-authors for all the efforts they try to make in the paper for distinguishing the different effects at work, because there's a lot going on in this paper. Of course, the contribution is also that the model replicates several features of the data. The distribution of leverage, credit spread are very well reproduced. And in my opinion, this is somehow the weak point of the paper, because to a lesser extent is, although you mentioned it, it's not targeted, the distribution of debt maturity is a little bit less better fitted. Okay? And you also show the interplay between stronger rollover risk and debt overhang with larger shares of maturing debt, make firm level more investment more sensitive to changes in monetary policy. Okay, so what you don't realize maybe because it was a short presentation is that the paper really represents a colossal amount of work, both on the data side, because there are very, very numerous sensitivity and robustness checks, and the model. Also, there's a lot of work to understand the intuition. So overall, it was very nice. It is, in my view, important as well, as it can contribute to better understand not only monetary policy, but firm dynamics depending on financing condition. And this is going to be my first comment. I was a bit frustrated because the firm level work is outstanding, but then you don't exploit this. It's a low-hanging fruit for you to give us the aggregate effect, but we don't have them. So basically, you focus on firm level effects, which is, in my opinion, completely legitimate to look at first. But then we want to know if there are composition effects as a result of general equilibrium interactions that counteract this higher sensitivity. And in the end, we wonder in a counterfactual, for example, economy where maturity would be the same across all firms, would monetary policy be more or less effective? We don't know. Okay, so I think that it's a relatively easy exercise for you and your co-authors to do, to show us the aggregate implications, and looking not only at the intensive margin, but also at the extensive margin. I think that would make an additional outstanding contribution. Yeah, so that's what I say. And even the fact that we have to wonder whether it matters qualitatively or quantitatively means that I think this is a question worth asking and answering. And you have everything in the model to answer this. And at the beginning, I thought this was why you were doing the model. The data might be more tricky, but still it would be interesting to have it maybe at the end of the paper as an additional section. Now I have more specific comment. This was about the scope. Now, on your empirical section, I conceptually don't understand very well why MIT minus 1, which is the structure of maturing debt from the last period, would be a good counterfactual, a good placebo. Because in my opinion, the maturity structure is a very persistent variable. By definition, because debt is maturing slowly, you mentioned it, the average maturity is 8 years in your sample. So I don't really understand, I did not really understand why it was like this. I expected MIT to be very autocorrelated. Then I think it's more or less joins the questions of Ricardo about the controls and maybe also the level of some effects, because is there anything in your controls or in the level of your estimation that give you, like for example about liquidity, or that give you interesting information about the design of financial frictions? For the moment, it seems that the design of your financial friction is justified by common sense or maybe a bit of literature and also the need to match the data. But maybe there is something that you don't exploit in the data that you could use to reverse engineer the important variable and therefore maybe the form of the cost that you want to have to generate the financial friction. And then last remark, results are derived for expansionary shocks because you have local projections, so you could look at the effect of expansionary shocks. Would they be symmetric, not symmetric? I think it would be interesting to see whether you have a significant asymmetry here, as you mentioned at the end of your slides. Okay, about the model. You have a very nice entry ladder process to generate the distribution. And you also have, and this was really clever, the capital quality shock. So you have two shocks. You have one draw of productivity that follows this ladder. So firms can only more or less become more productive. But then they are potentially, after production decisions are made, affected by a capital quality shock. And this generates a lot of persistence in the financing decision and in particular in maturity. Okay, so, but the main, I believe, weak point for the moment of the paper, and I think you can really improve on it, is that you do not have enough dispersion in terms of maturity. And it's your main point, so it's a bit So you match the dispersion of liquidity very well, credit spread very well, amazingly well, but not maturity. I think, and you have like the unconditional distribution that is too flat, it should be more skewed, and your results, your empirical results indicate that, or the theoretical results, maturity is affected by size more than age, and in the data it's the opposite. It seems that it's more dispersed by age than by size. So could you find a way to, I don't know, maybe by targeting this, because this seems to be critical to your point, to solve the problem, or consider maybe alternative debt issuance costs, maybe lumpy costs, okay, or irreversibilities, I don't know, but something that maybe could introduce more asymmetry between short and long-term bonds, because for the moment you aggregate everything, and you make the issuance cost quadratic, or I mean convex, as a function of aggregate debt. Maybe you could separate that. That was a clarification question, but so it seems that you have, like, because of your exogenous entry process, you seem to have TFP growth, and you seem to have, so I wondered whether you had balanced growth in the model. Well, this is a nerdy macroeconomic question. Okay. Now the open questions, maybe, that I was asking myself when reading the paper. What about the normative implications? You mentioned them, but I think it would be super interesting. Is there anything, for example, that macroprudential policymakers could learn about your model? It seems to be really suited to handle this kind of questions. QE, of course, by definition, QE is playing with the yield curve, the relative maturity, different maturities. And also, central banks, ECB with the CSPP, for example, have been directly buying corporate bonds of different maturity, especially long-term bonds. So how would, I mean, you could use your model to evaluate that. Could be super nice. Overall, lots of important questions that you could really answer with this beautiful framework. I think this is a more research statement than just a single paper. So I really look forward to reading the subsequent versions. Thank you very much.
Thank you again. So since we are running a little bit out of time, I suggest we collect only a maximum of 3 questions from the floor if there are. So there is Riccardo, Ambrogio. So that we have 3. Okay. And then we can postpone the discussion to the coffee break.
So I was trying to understand here this rollover risk in the model, and help me here because let me just present a much simpler model than the one you have. Firms are an abstraction, like we've learned. What there are in the economy are projects. And whenever I start a project, I issue a corporate bond to fund that project. And there's some long-term projects, there's some short-term projects, but a bond is tied to a project, which is actually not a bad approximation of reality. What that means is that while a project is going, the bond is outgoing. If the monetary policy or interest rates change, who cares? I invested at date 0, I made the investment, the payoff comes at date T, that's when the project comes due, that's when the corporate bond comes due. Now, what that means is therefore that in any one quarter, when you see corporate bonds coming due, it's because a bunch of projects got finished. As a bunch of projects got finished, some entrepreneurial capital and not got released, and they're now thinking, do I start a new project or not? The interest rate is obviously relevant for whether I have that entry, if you want, into new projects or not. I think this model kind of captures what you've shown. It doesn't tell me anything about rollover or anything. It's basically, I've just told you a heterogeneization story of why is it interest rates matter for investment. They matter for investment because there's basically only at the margin where only some things end and we're about to start new things. Depending on the real interest rate, things are I'm gonna do more of them or less. So now, that's fine. You know, I just gave a different story for your model, for your facts. But it does say something which is like, are we really learning from your model like about rollover risk or something else? Or are we just kind of giving substance to the idea that higher interest rates means we invest less? And I just gave you a very Arrow de Breu story of why interest rates come to invest less without telling much about rollover or debt overhang or not.
Thank you. Mine is a question, is really a clarification question on your sample. And so, as you said, you have kind of a subset of CompuStats. And the fact that was particularly striking to me was the fact that you seem to have, in your moment matching, you had leverage being high for very big firms. Is that correct? Is that what you had? Like leverage is increasing in size, right? Which I found surprising because in the sample of super large firms and I guess non-risky firms that you're probably looking at, you would expect this type of credit rationing not happening really. You know, I would have expected large firms to be non-risky, low leverage with low credit spreads. And so I was wondering whether there is anything in particular that is going on in your subsample. You know, this fact is kind of against what I would have guessed as a prior. So it's really a clarifying question on that subsample. Thank you.
So you're already doing a lot in the paper, so I wouldn't ask you to do this, but I think it's important to comment on the fact that, you know, because you showed that debt dilution, or what you called debt overhang, is the main amplification force, that you should discuss that, you know, financial markets go around that problem, particularly by putting covenants. So what old bondholders do is they say, look, you have restrictions on new issuances that we contract. And so, you know, Sufi has, like, before he was a macro guy, he had like work on this. So that's one place to look.
I actually really like this paper, and I think the issue and many questions you're asking, going back to Ricardo's question, is the mismatch between the model and the data. I think the model is really about using a representative sample of universe of firms. I mean, there is all sorts of different financial constraints and different financing, and that's exactly why rollover risk is relevant. But you can't really get that in the data without the small firms. So the data is the bond financing, and I mean, don't get me wrong, there's definitely a bond channel of monetary policy, but the model is written more for the bank debt and the short-term debt. And that's the small firms in the US. And we see this very clearly in the Y14 data, the new regulatory data of the Federal Reserve. And I presented this paper at this year NBR Summer Institute EFG meeting. So all those questions you're asking about the data and why the model fails there, they are in the data. It's just not this data used in the paper. So I'm wondering, maybe we are not doing justice to the model in the paper because the data is a mismatch to that model. Thank you.
Joachim, if you can in 5 minutes so that we have the break, then we can discuss over the lunch.
Okay, yeah, thanks for all these questions. So thanks all for the discussion. It was really great, and I cannot answer to all your points which you raised. Maybe quickly, so the counterfactuals, which we can do with the model, you're very right that we didn't do them yet. So that's definitely on the agenda. And we also, one thing which I already want to answer, so at this point we're a bit unfair to all the control variables. We only focus on M a lot, maturing bond share, and it's true we didn't investigate or show much the signs of other control variables, and it's true that we could learn more about them. I just showed you what leverage is doing, but there are other interesting variables there, and which we didn't look at yet, and we didn't show you, of course. And let me try to briefly answer the other questions. We can talk more later, hopefully. First of all, about one idea, one model, alternative model, which could relate investment to debt maturity is project matching. So firms match debt length to project length. This would generate the estimate. This would inform the estimate, which you asked about, which I didn't show you, the gamma. So the correlation between average investment and maturity of firms. So it wouldn't necessarily tell us what happens when lots of bonds are maturing and a shock is happening for monetary policy at the same time. Okay, yeah, then probably I have to think more about this in 2 minutes. You're saying that I'm ending and now I'm disposed to react by starting or not. Okay, yeah, that's fair, exactly. So let me, maybe I have to think more about that but yeah. Okay, I see the point, yeah.
There's no financial friction in what I said. There's a technological friction, and still I can get your fact. Now, this is great because shows your facts are very interesting and very robust. It's just that you're kind of pushing it a little, like Shep was saying, no, it's this story, the role.
No, exactly. It would be a different theory of maturity structure, one driven by project length and potential. So one was about covenants. That's true. So in many long-term debt contracts, there are covenants there. They're more common for bank loans, and that's also the work which Sufi, for instance, looked at. So for corporate bonds in the US, there are less covenants, and particularly, yeah. So it's, of course, they are there and they do something, but the covenants are less helpful to deal with agency problems related to bonds outstanding to many creditors in markets where renegotiation is costly, then when it's opposed to a two-side contract, the bank and lender. So that's we shouldn't expect covenants to be as efficient for bonds than for loans, and they're also less frequently for bonds than for loans. But in principle, that's a fair comment, that we don't have covenants in the model at all, and in the data to some extent they are there. Yeah. Yeah, but exactly, we can talk more about this because we looked a bit at that evidence there. And lastly, yeah, Shebnem's comment. I hope she can hear me. So it's, I think it's also true that small firms are more likely or more prone to expose to rollover risk. And so if we could have the same data for small firms from the same regressions, we would expect to have maybe even larger estimates. And for that, we would probably also need a different model. So in our model here, there's equity issuance happening and it's not too costly. And so this is different for private firms. And so a model where equity issuance is very costly and so cash flows are very important would also generate probably a bigger role for rollover risk than we have. So that's a point taken, yeah.